What's going on, everyone, on YouTube, TikTok, wherever you've seen me at? Well, today we're going to talk about another stock. So, to add to my dividend portfolio, or maybe not, it all depends on the situation. Now, before we get into this, you need to kind of know why I'm building this portfolio. Well, it's my bridge account. It's an account that helps me pay for my early retirement because I kind of want a fat fire retirement. Right now, I'm considered coast fire, which means this. Now you know what coast fire is and why you see me wanting to build a bridge account. I am looking to do this in a brokerage account. So there's no tax advantage. This is something totally separate. And you need to understand one thing. I'm not a financial advisor. I'm just some guy on YouTube building up a bridge account, and you're just following along my journey. Why am I building a bridge account with a dividend portfolio? Is because I believe passive income comes from two different things.
I think the reason so many scum buckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate, and you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
I also believe in owning a piece of the company. So I look for companies to purchase that I believe will be a great asset to me. Not because they're the latest trend, not because they're a meme, but because they're nice stocks. They have a good return on them. They have a solid foundation, and that I want ownership on them. So there's a bunch of different reasons why you can own a stock, but for me, it is to have ownership in that company. Now, Warren Buffett said this about investing.
Warren Buffett, the man with a net worth of over $100 billion, has a story to share. Here's what he did.
When I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. And I read Garfield, Drew, and all that. I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business.
Now, before we get into this video on what stock it is, we're going to get into what my requirement for the stock is. Now, my requirement is pretty simple. It's going into my dividend portfolio, so it needs to pay dividend.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
It needs to have, number two, financially stable. They have to be making good money, good financial standing. Number three, they have to have a good growth opportunity. I don't want to buy stock the performance been doing -5, 7. I want a good performance stock. And number four is that I want ownership of the company. Now, my portfolio right now is still small. I haven't decided fully on how many I want to purchase for my portfolio, but it'd probably be about 40, 50 stocks in my dividend portfolio. So I'm gonna allow it to grow. And once I buy these stocks, I'm in it for a long term. So I'm doing my due diligence to my specification. It might not be towards yours. So let's get into this video. What company am I looking at today? Well, I noticed in my portfolio, I didn't have any in the energy sector. So I'm looking into Duke Energy. It's the first dividend company that came up when I Googled, and I don't know if I'm gonna purchase it yet. It's the first time I heard of them. But if you don't know what Duke Energy is, here's a video about them.
Duke Energy, headquartered in Charlotte, North Carolina, is one of the largest electric power holding companies in the United States. The company provides electricity to approximately 7.7 million customers in the Carolinas, the Midwest, and Florida, and natural gas distribution services to more than 1.6 million customers in Ohio, Kentucky, Tennessee, and the Carolinas. Its operations span 3 major areas: electric utilities and infrastructure, gas utilities and infrastructure, and commercial renewables.
Well, that's Duke Energy. So it's an energy company. It looks like it's doing pretty well. Here's the website. Now, I'm going to go into the Wikipedia page to see what they're about. I like Wiki because it sums it up and makes my life a little bit easier. So Duke Energy is an American power company that has electric power and natural gas holding company, and they're based in North Carolina. Okay. So it has a bunch of subsidiaries, has a pretty long history. So, okay, it's been around for a while. And here is the thing I like to look at is the revenue. Revenue's been growing every year. Net income looks like it was growing until 2021. It took a dip. Total asset, it looks like it's been increasing. And employees, it looks like it's pretty stable at 27,000 employees. Okay, so they look like a decent company. So let's get into and see what we can learn about them. So year to date, they're 12%. Okay, 12% or 0.12%. 1 year, they're negative 3.17%. 3 years, they're 18.15%. And 5 years, there's 39.86%. That's not that great of growth, but let's look at the finance to really see why. But before we look at the finance, let's look at the dividend history since it's going to my dividend portfolio. So it pays a 3.34%. That's a pretty good annual dividend yield of $4.26 and dividend track record of increase by 20% and dividend payout of 69.27. So it's a pretty decent stock for dividend payout, especially at 3.34%. So yes, it pays dividend, pays a pretty good amount, and I do like that. So now the performance hasn't been that great, but that's kind of understanding. So let's look at the finances. Is it worth it keeping? Now, I don't really worry about what the performance does, but I'm mainly worried about the money and finance. I want to make sure there's a good profit margin and that they have been increasing revenue year over year. And based off this information right here, from 2017 to 2024, revenue has increased. It hasn't increased a great lot, but it has been increasing about 2%, 5%. 2022 increased 16%. So it has been increasing year over year. That's great. Now, the other thing I like to see is the margins. How much money are they making? And the net profit. Net profit shows how much of each dollar revenue translating to profit. The higher is better. So they stay about 15%, 14% last few years. I like to see this. So they're making 15%. I personally like that. So I think they're financially stable with that profit margin. Now, another thing is I like to make sure that they're not in a negative. So current asset, fixed asset, intangible, is it less than current liability? Yes. Is it less than their long-term debt? Yes. So their long-term debt plus their current liability is about $94 billion. but their fixed assets is higher than that. So mathematically, they're doing pretty well. They're worth 120 billion, and that's fine with me. Now, the other thing I want to check is why were they doing bad past few years? Well, let's look at this. Their cash flow position. Okay, they're in the negative billions, negative 5.4 and negative 2.73, and now they're in a positive 48 million. So financially, they look like they finally got out of the rut, and they should be fine financially. Now, it looks like they do give stock option. They've been selling it. That makes it hard for the stock price to go up, but hey, that's okay. So I looked at the performance, I looked at a dividend, and I looked at the finance. Financially, I think they're okay. Now, performance, they haven't been doing too hot. But it looks like for me, they just got out of the rut. So I'm thinking about purchasing it, but let's see what AI says. So AI say the valuation is 4 out of 6. Let's compare it to everyone else. Okay, the valuation 4 out of 6 makes sense. Earnings. So I like to see the earnings. Have they been meeting their earnings? Okay, they've been meeting it from 2024, Q1, Q2. So they've been surpassing it. It has been showing a negative, but that might be because the finance wasn't that great. But it's all right. Future growth. Well, future growth is 5 out of 6. I agree with it. So this is a good possibility for performance to increase. And then historical performance, compared to everyone else, is doing better. And financial health, it's not doing so well. Because of what was going on last few years with it, it finally got out of the rut. So it makes sense. They just got out of the rut. They just got positive on their cash flow. So, what do I think about this Duke Energy company? It looks like I'm going to buy them. I'm probably not going to buy a lot, maybe $500 worth at this time, just to see how they're doing. The reason why I'm going to purchase them is because it looks like, based off their finances, that they just got out of the rut. They're just getting out of the situation where they're in the negative and going into the positive. So it looks like it's a great time for me to buy. According to the performance charts, it's not doing so hot. But according to the finance, it looks like it just did a turnaround. Q1, Q2, looks like they've done well, so it should keep up with it. So financially, this is a big energy company, and energy hasn't been doing too hot lately across the board. But if this is the case and it does better, guess what? It's going to have a great performance due to exponential growth. And I'm not going to say it will, but I'm going to take the risk. Since I have about 30, 40 years before I even need this money, I'm willing to take the risk. And I do need to diversify my portfolio. So what's the harm of adding this energy company to my dividend portfolio? I don't see a problem with it. Now, is it the best one to add? Probably not. But for me, seeing that it's just getting out of the rut and then in the positive now, and they have a gross profit of 15%, I'm willing to take the chance, especially if I'm hoping to hold on to it the next 5 years with a 33% return. I'll take the chance. Like, subscribe to my video. That's all I got.